Hey, welcome to Finance Deep Dive. Today, we're analyzing Braemar Hotels and Resorts, ticker BHR, a luxury hotel REIT. Can its stock soar to $1,000? Spoiler alert, it's a long shot. We'll break down strengths, weaknesses, financials, competitors, dividends, and what's next by 2030 and beyond. Let's dive in. Hit that subscribe button for more stock insights. Braemar owns high-end properties like Four Seasons and Ritz-Carlton, targeting wealthy travelers. Strengths: a premium portfolio with strong revenue per room potential, a 9% dividend yield that beats the industry, and experienced management from its Ashford spin-off. Weaknesses: it's drowning in $1.23 billion of debt, profits are negative, and its small portfolio, fewer than 20 properties, makes it vulnerable compared to bigger players. Opportunities include tourism recovery for 2026 events like the World Cup. Threats: economic downturns and high operating costs. Let's talk numbers. Braemar's net profit margin is negative at -0.07%, and its operating margin is 10%. Gross margin slipped from 25% in 2021 to 20.6% in 2024, down about 1-2% yearly, thanks to rising costs like labor and energy. Debt to equity is a hefty 186%. $44 million cash flow barely covers $96 million in interest. Side incomes like management fees help, but the balance sheet's shaky, with equity dropping to $267 million in 2024. Since its 2013 IPO at around $20, BHR's stock has tanked to about $2.25, a roughly 90% loss for investors, even with dividends. Looking ahead, Braemar's betting on asset sales and refinancings by 2030, like its Four Seasons Scottsdale deal. Long-term, by 2040 to 2050, it could lean into ESG trends like energy-efficient hotels, but don't expect $1,000. Analysts see maybe $10 by 2030 in a best-case scenario. Tourism growth could help, but no specific 2050 plans are public. It's a speculative recovery story hinging on sales, refinancing, and macro demand. Expect slow, conditional upside rather than a home run. Braemar pays 20 cents annually, a 9% yield. Great for income investors. But it's no dividend aristocrat. Payments are stable but haven't grown consistently since pandemic cuts. Short-term, BHR is up 22% year-to-date in 2025, beating the S&P 500's 18%. Long-term, it's a loser, down 50% in 5 years while the S&P soared. Compared to global indices like Germany's DAX or Japan's Nikkei, BHR's volatility stands out. REIT indices like FTSE Nareit are up 5 to 10%, so BHR's not alone in lagging. For income seekers it's tempting, but understand the policy and refinancing risks behind the yield. How does Braemar stack up? Host hotels post 40% gross margins, Apple Hospitality around 35%, while Braemar's around 20.6%. Smaller size and luxury focus mean higher costs. Host hotels 10 to 15% net margins, Apple 5 to 10%, Braemar at -0.07%. Can it pay $1.23 billion debt? Short-term, maybe with refinancings, but weak cash flow is a red flag. Rivals like Diamond Rock and Chatham Lodging outperform on margins. Braemar's a high-risk bet for dividend seekers, not growth investors. So will BHR hit $1,000? Not likely. $10 by 2030 is ambitious enough. It's a high-yield play with big risks. Heavy debt, weak profits, and tough competition. Want more stock breakdowns? Like, subscribe and check our sources below. See you next time.